Okay, let's unpack this. I want you to picture something for a second. You're cruising along, career's on track, bills are getting paid, maybe you're even, saving a little. Life feels pretty stable, right? And like most people, you probably have this quiet assumption humming in the background.
Bad stuff, like a major illness or a disabling injury. Yeah, that happens to other people.
It's a really comforting assumption, isn't it? Almost like a necessary one to get through the day sometimes. But what the data from our sources absolutely screams is that this assumption is dangerously wrong for a huge number of working adults.
The dangerously wrong is right. Get this statistic from the material we looked at. A staggering 1 in 4 working adults will become disabled at some point during their working years.
1 in 4.
1 in 4. That's not some, rare occurrence. That's a significant probability. Think about the people you know at work, your friends, your family. Statistically, a quarter of them, of us, will face a period where we can't earn a living because of our health. And the financial reality of that is just, well, it's brutal. Our sources don't sugarcoat it. They draw a direct line between severe illness or injury and financial ruin.
Yeah.
Citing that these health crises are major drivers, potentially the majority drivers, behind things like bankruptcies and foreclosures in the U.S. It's not just about managing discomfort or adapting your daily routine. It can fundamentally shatter your financial foundation.
Exactly. It transforms from being an inconvenience, something you deal with, to a potential path to complete financial collapse. So this deep dive is all about protecting your most valuable asset, really, your ability to make money. We're diving into long-term disability insurance here in the U.S., what it is, why it is so incredibly crucial in light of those statistics, and exactly how it works based on the stack of sources you've shared with us.
Yeah, our mission today is to really get into the details from this material, the foundational concepts, the policy mechanics, the surprising elements like taxation.
Oh yeah, the tax stuff is wild.
It really is.
Yes.
And even how to navigate the challenges of actually making a claim and pull out the absolute must-know nuggets you need to walk away feeling genuinely informed and empowered about this topic.
We've got everything from the basic explainers to deep dives into policy fine print and fighting denials. So let's jump in. First off, let's define what long-term disability insurance actually is and truly understand why it's highlighted as being so critical.
Okay, so at its core, as the sources repeatedly emphasize, long-term disability insurance, or LTD, is simply income protection.
Right.
It's designed to step in and replace a significant portion of your salary when you are unable to work because of a disabling condition. The material indicates this typically means replacing anywhere from, say, 60% to 80% of your pre-disability salary.
And it's vital to distinguish this from short-term disability, STD. A lot of employers offer STD, which is great, but it's a temporary bridge.
Exactly. Temporary is the key word. It usually covers shorter periods, like recovering from surgery, a short illness, or maybe maternity leave, often lasting only up to 6 months, maybe a year at the outside.
Okay.
LTD is for the long-haul disabilities. It's designed for conditions that prevent you from working for much longer periods. Depending on the policy, it can provide benefits for several years, maybe 2, 5.
Or even longer.
Oh, yeah. Or even extend all the way through to age 65 or your full retirement age. That long-term support is what makes it distinct and so crucial for financial survival during extended periods without income.
Now, when we think about a disabling condition, I think people often picture like a really dramatic accident, but the sources show the reality is much broader, right? Covering a huge range of illnesses and injuries. What kind of conditions are we talking about here?
Oh, the lists provided are extensive. I mean, yes, severe injuries like major broken bones or nerve damage are definitely covered, but the material highlights that chronic illnesses are equally, if not more, common reasons for long-term disability claims.
Like what sort of things?
We're talking about back and neck disorders, which are huge. Carpal tunnel syndrome, chronic respiratory diseases like COPD, heart disease, kidney disease, various forms of arthritis, osteoarthritis, rheumatoid arthritis, stroke, persistent issues with knees, shoulders, or eyes, chronic pain syndromes, fibromyalgia, neurological conditions like multiple sclerosis and Parkinson's. It's a vast array of physical ailments that can render someone unable to perform the requirements of their job.
And it's not just physical, which I think is a really important point today. The sources explicitly mention mental health conditions too.
Absolutely. Conditions like severe anxiety, major depressive disorders, bipolar disorder, psychosis, PTSD, these are recognized as potentially debilitating to the point where someone cannot work. and that's covered.
Plus, the list extends to other chronic conditions many people live with or develop, like cancer, diabetes, chronic fatigue syndrome, digestive disorders like Crohn's disease and IBS, sleep apnea.
Even lingering issues from things like long-haul COVID are mentioned. It paints a picture of how pervasive the risk is. It's not limited to just a few rare conditions or only accidents.
Okay.
However, it's also important to note the common exclusions mentioned. Typically, policies won't cover disabilities stemming from pre-existing conditions.
Ah, the pre-existing condition clause.
Right. Those diagnosed or treated before the policy begins, though the specifics on look-back periods can vary. Also, typically excluded are self-inflicted injuries or injuries sustained while committing illegal acts.
Okay, so it covers a wide range of potential health problems. This begs the question, who really needs this? Is it everyone? Is it just people in, physically dangerous jobs?
The sources are quite clear on this. Fundamentally, anyone who relies on their income to live needs this protection.
Plain and simple.
Yeah. If your household budget depends on your paycheck, your ability to earn is your most critical financial asset, and, well, it needs safeguarding.
But it seems it's emphasized even more strongly for certain groups in the material.
Yes, particularly for high earners and those in specialized professions. Think about it. These are individuals who have often invested significant time, money, and education to reach a high earning potential.
Right. Years of training, maybe advanced degrees.
Exactly. Doctors, lawyers, engineers, IT specialists, pilots, consultants. The sources specifically call out professions like anesthesiologists, software developers, financial advisors, surgeons, and dentists. If you're earning a high income due to specialized skills, losing the ability to use those skills means a much larger financial cliff to fall off. LTD protects that significant investment in your career and your high earning capacity.
That makes perfect sense. And what about for the self-employed freelancers, small business owners?
Oh, for them, it's arguably doubly important.
Why doubly?
Well, not only do they lose their personal income when they can't work, but their entire business might collapse without them. It protects their personal financial stability, yes, but it's also essential for potentially keeping their business afloat during their absence, covering ongoing expenses.
Now, a lot of people are probably thinking about Social Security Disability Insurance, SSDI. Doesn't that cover you if you become disabled? Is LTD even necessary if SSDI exists?
SSDI is definitely part of the conversation, and it's a government program funded by payroll taxes. It can provide a basic safety net.
Yeah.
However, the sources highlight a couple of critical limitations.
Okay.
First, it's often much harder to qualify for SSDI compared to a private LTD policy. The definition of disability under SSDI is extremely strict. You generally have to prove you cannot perform any substantial gainful activity.
Any job, basically.
Pretty much, yeah. Not just your own job. And that your condition is expected to last at least a year or result in death. It's a high bar.
So if you're that surgeon we talked about, the one with nerve damage who could maybe still teach, SSDI might say, nope, you're not disabled because you can still work as a teacher.
Exactly. Even if teaching pays a fraction of a surgeon's salary. And second, SSDI benefits are typically much lower than what a private LTD policy would provide. Our sources conclude that while SSDI is a potential layer of support, it's usually not an adequate sole source of income protection for most people, especially for higher earners or those with significant expenses.
And for the self-employed business owner, SSDI doesn't help cover business expenses, like rent or payroll, right? Which are crucial to keeping the doors open while they recover.
Precisely. It's personal income replacement only, and often quite limited at that. So, relying solely on SSDI is a very risky strategy, according to the material we reviewed.
Okay, so we understand what LTD is and why it's essential for many, particularly income earners. Let's shift gears and talk about the nuts and bolts.
Yeah.
How does a policy actually work? What are the key pieces you need to understand?
Right. The sources break down several key components. First, the benefit amount. We touched on this. It's the percentage of your pre-disability income the policy replaces.
Usually 60 to 80%, you said?
Yeah, usually 60% to 80% for group policies offered by employers, maybe a bit lower, like 40% to 65%. For some individual ones you buy yourself. But a really critical point highlighted here, and we'll dive deep into this later, is that the taxability of this benefit depends entirely on how the premium was paid. That dramatically impacts the net amount you actually receive in your pocket.
Got it. We'll definitely circle back to taxes. Then there's the benefit period.
This is simply how long the policy will pay you benefits if you remain disabled, according to the policy terms. It's a significant policy choice that impacts cost.
So it could be short-term, like a couple of years?
It could be a fixed number of years, perhaps 2 or 5, or it could extend much longer through age 65 or even up to your normal Social Security retirement age. A longer benefit period offers more protection, but naturally it costs more in premiums.
Okay. Now, a concept that feels less intuitive but seems really important for planning is the waiting period, sometimes called the elimination period. What's that about?
This is a really crucial period. It's the time right after you become disabled during which you must wait before your disability benefits start paying out. It's essentially like a deductible, but measured in time instead of dollars.
How long are we talking?
The sources say these typically range from 30 days on the very short end up to 180 days. Sometimes, though less common, it can be as long as a year.
Wow, 180 days. That's 6 months without that income stream starting.
Exactly. And you mentioned the link to short-term disability earlier.
Yeah.
This is where it often connects.
How so?
Well, if you have STD coverage through an employer, your LTD waiting period is often designed to align perfectly with your STD benefit period. So, for example, if your STD covers you for 180 days.
Your LTD waiting period might also be 180 days.
Precisely. So your LTD benefits would ideally kick in right after your STD benefits run out. It aims to create a seamless transition of income replacement.
But if you don't have STD, or your LTD waiting period is longer than your STD lasts, or maybe you're self-employed with no STD, you have a significant income gap to bridge on your own.
Exactly. The sources emphasize this point strongly. That waiting period is basically unavoidable in group policies and absolutely standard in individual ones. You won't receive an LTD check for at least a month or two, possibly much longer, after becoming disabled.
Which screams emergency fund.
Absolutely. This is precisely why having an emergency fund covering 3 to 6 months of essential living expenses is critical for everyone, but especially for those without a robust STD plan bridging that gap.
Yeah.
You're on your own during that waiting period.
Okay. Now, perhaps the most critical part of the policy fine print, the thing that determines if you actually qualify for benefits based on your condition, the definition of disability.
This is absolutely vital. And this is where understanding the difference between own occupation and any occupation is, well, it's non-negotiable.
Okay, break those down for us. What's own occupation?
An own occupation definition means the policy considers you disabled if you cannot perform the substantial and material duties of your specific job or specialty that you held when you became disabled.
Your own job.
Yes. This is the most protective definition. It doesn't matter if you could potentially do another type of work. If you can't do the job you were trained for and were doing, you qualify for benefits under this definition.
The sources give that classic example, right? The surgeon develops nerve damage in their hand, can no longer perform surgery. Under an own occupation policy, they would continue receiving benefits because they can't perform surgery, even if they could still do something else, like maybe teach medical school.
Exactly right.
Yeah.
It protects your ability to perform the specialized job you've built your career around and protects that higher income level associated with it. Now, compare that to any occupation definition.
Okay, what's that?
Under this definition, you are only considered disabled and therefore eligible for benefits if you cannot perform any work for which you are reasonably qualified based on your training, education, and experience.
Any work you're qualified for. That sounds much tougher.
It is. So, with a surgeon example, under any occupation policy, if they can teach medical school, even if it pays significantly less.
The policy would likely stop paying benefits once they are deemed capable of teaching.
Correct. It's a much lower bar for the insurance company to meet to stop paying benefits, as they just need to find some job you could reasonably do. This offers significantly less protection than an own occupation policy. It's a huge difference.
I see there's a hybrid mentioned too.
Yes, sometimes policies offer what's called a 2-year own occupation definition or something similar. This means for the first 2 years of disability, the more generous own occupation rule applies. But after those 2 years, the definition switches to the stricter any occupation standard.
So good protection initially, but then it gets harder to qualify long-term.
Exactly. It provides good protection for the initial period, but then becomes less generous. Understanding which definition is in your policy is absolutely paramount when comparing options or reviewing existing coverage.
And related to this, you mentioned the idea of partial or residual benefits earlier. That seems important for situations that aren't totally black and white.
Yes, this is often an optional add-on, what's called a rider, but it's a very valuable one. It addresses situations where you aren't totally disabled, but your condition prevents you from working full-time or performing all your previous duties. resulting in a significant loss of income.
So you can still work a bit, but not earn what you used to.
Precisely. A residual or partial benefit rider allows the policy to pay a reduced benefit amount to help make up for a portion of that lost income while you're partially disabled. This is crucial for conditions that fluctuate, or during recovery periods when you might return to work part-time, or even if you return full-time, but at reduced capacity or lower pay due to the disability.
Okay, that covers the core components pretty well.
Yeah.
How do you actually go about getting coverage, and what should you expect to pay? Where do people find these policies?
Right. The sources outline two primary avenues for obtaining LTD coverage. The most common for many people is through an employer via a group plan.
Like as part of your benefits package.
Exactly. These are often easier to get, sometimes require little to no medical underwriting, especially if you enroll when first eligible, and they can be more affordable due to the group rates.
But the big downside is they're tied to your job, right?
That's the main one. If you leave that employer, you generally lose the coverage. The other option is buying a private, individual policy directly from an insurance company.
Going out and getting it yourself.
Yep. This requires more effort on your part. You have to apply, go through medical underwriting, which means disclosing health history, maybe getting an exam, but it offers much more control over the policy terms, like ensuring you get that own occupation definition, choosing specific riders, and crucially, it's portable. It stays with you regardless of your job changes.
That portability sounds essential for people who change jobs frequently or, as we discussed, definitely for the self-employed.
Absolutely vital for the self-employed. An individual policy is often their only practical option for personal income protection. And as the sources point out, getting an individual policy when self-employed can be a bit more involved.
How so?
Insurers typically want to see a track record, often requiring proof of being self-employed for maybe 2 years, and they'll want to look at tax returns to verify your income level accurately.
Makes sense. And for business owners, getting that individual income protection isn't the whole story, is it? There's the business itself to think about.
Right. The sources also mention specific business-related coverages they should explore alongside personal LTD. Business overhead expense, or BOE, insurance is key.
What does BOE cover?
It covers the ongoing operating costs of the business while the owner is disabled, things like rent, utilities, employee salaries, insurance premiums, property taxes. It often reimburses up to 100% of covered expenses, allowing the business to continue running. There's also business loan coverage mentioned to ensure business debt payments are met. These policies protect the business itself while the owner focuses on recovery.
So, personal LTD for your income, BOE for the business bills. Got it. How do you figure out the right amount of coverage to buy, personally?
It really comes down to figuring out your essential monthly expenses that would still need to be paid if your income stopped completely.
Like the non-negotiables.
Exactly. Housing costs, mortgage or rent, food, loan payments, student loans, car loans, childcare, insurance premiums you pay, utilities, and maybe even contributions to retirement or college savings if possible. You tally that up. For business owners, you also add in those critical business operating expenses we just discussed for BOE.
And the policy replaces a percentage, not the whole amount usually.
Correct. Personal income replacement policies typically cap out around 60–80% of your pre-disability income, sometimes less for individual policies. BOE policies, covering business expenses, can often cover up to 100% of approved expenses. The goal is to figure out the minimum income needed to keep your personal finances and, if applicable, your business afloat during a disability.
Okay, let's talk about the elephant in the room for many people. The cost. This sounds important, but is it expensive? What should someone budget for this type of insurance?
Cost is definitely a factor, and it varies. But the sources provide a helpful general guideline and detail the variables. The cost for an individual policy varies significantly based on things like your age and gender.
How so?
Generally, younger people pay less because they're statistically further from disability. Historically, men often paid less than women for individual LTD policies due to differing claim statistics, though group rates are usually unisex now. Lifestyle choices matter. Tobacco users definitely pay more, often a significant surcharge.
And your job.
Your occupation is a major driver of cost. Someone in a physically demanding or high-risk job, say a construction worker or a pilot, will pay significantly more than someone with a desk job due to the higher likelihood of injury or disabling condition affecting their work.
And the policy design itself impacts the cost, right?
Yeah.
The choices you make.
Absolutely. A higher monthly benefit amount obviously costs more. A longer benefit period paying benefits for more years costs more. A shorter waiting period meaning benefits start sooner after disability costs more. And adding those optional riders we'll discuss later adds to the premium as well.
So what's the rule of thumb cost?
The widely cited rule of thumb from the sources is to expect to pay somewhere between 1% and 3% of your gross annual income for a good individual policy.
Okay, 1 to 3%. That's a tangible range people can grasp. The examples in the sources really make it concrete, like for someone earning $75,000 a year.
Right. 3% of $75,000 is $750 to $2,250 annually. Divide that by 12, and you're looking at about $63 to $180 per month.
And for someone making, say, $150,000.
That range would be $1,500 to $4,500 annually, or roughly $125 to $375 per month.
You know, when you look at those monthly numbers, it feels more manageable. Like it's maybe the cost of a couple of nice dinners out, or a gym membership, or a streaming bundle.
Exactly. And when you weigh that monthly cost against the alternative, potentially losing 100% of your income for years, that 3% suddenly looks incredibly reasonable, maybe even essential.
It really puts the potential cost into perspective against the potential catastrophic loss. Another key policy feature mentioned is renewability. This affects the long-term stability of your coverage and cost, right?
Yes, this is crucial for peace of mind over the potentially decades you might own the policy. The gold standard here, according to the sources, is a policy that is non-cancelable and guaranteed renewable.
Okay, what does that mean exactly?
It means that as long as you pay your premiums on time, the insurance company cannot cancel your policy for any reason, and they cannot increase your premium rates, change your benefits, or revise any policy provisions. Your coverage and your cost are locked in from day one, usually until age 65. It's the highest level of security.
That sounds like what you'd want if you can get it. What are the less comprehensive types?
Next down is guaranteed renewable. With this type, the insurer still cannot cancel your policy as long as you pay the premiums. However, they can increase premiums or potentially lower benefits or change provisions, but there's a catch.
What's the catch?
They can only do this for an entire class of policyholders who have the same policy type in your state. They can't single you out because your health changed. And these changes often require approval from state insurance regulators. So you're protected from individual changes, but not from broader rate adjustments affecting everyone with that policy form.
Still pretty good protection, but not quite locked in like non-cancelable.
Right. And then the least secure type mentioned is conditionally renewable. Here, the insurer has more flexibility to change rates, benefits, or terms as specific renewal periods outlined in the policy. The policy you buy today might look quite different or cost significantly more years down the road.
So the advice is?
The sources strongly recommend aiming for at least guaranteed renewable and ideally non-cancelable and guaranteed renewable if available and affordable for that long-term security and cost predictability.
Okay, let's walk through the process. What are the steps involved in actually getting an individual policy once you've decided it's necessary? It sounds like more than just clicking buy.
It definitely is a process. The sources outline several clear steps. First, you need to calculate your coverage needs, figure out those monthly expenses, both personal and business if applicable.
Right. Know your target benefit amount.
Second, think about which optional riders might be valuable for your situation. We'll talk more about the key ones next, but things like cost of living adjustments. Third, shop around. Get quotes from several different reputable insurance companies because rates and policy features can vary. Don't just go with the first quote.
Good advice for any big purchase.
Fourth, you'll fill out the application. And this step is absolutely critical. Be completely honest and accurate about your health history, any past conditions, medications, lifestyle habits like smoking, everything.
Why is honesty so crucial here?
Because any misrepresentation, even if unintentional, can be grounds for the insurance company to contest or deny a claim later, potentially years down the road when you need the coverage most. They can rescind the policy based on material misrepresentation. So, full disclosure is key.
Got it. What happens after you submit the application?
You'll likely have a phone interview where they ask more detailed questions about your health, lifestyle, job duties, and finances. Then, you'll need to provide supporting information.
Like what?
This usually includes undergoing a medical exam, which the insurer typically pays for. They'll also request medical records directly from your doctor. That's called an attending physician's statement, or APS. And you'll need to provide documentation to verify your income, usually tax returns or pay stubs.
So they do their homework on you.
They do. The insurer's underwriters Review all of this, your application, the medical exam results, doctor's records, financial documents, and any existing insurance coverage you might have to assess your risk profile. Based on that, they decide whether to issue a policy and on what terms. They might offer coverage as applied for, offer it with modifications like exclusions for certain conditions, or potentially decline coverage altogether if the risk is deemed too high.
And if they approve you,
you'll receive the final policy document. It's really important to review this very carefully. The sources note that you usually have a free look period, often 10 days, sometimes longer depending on the state.
what's the free look period for?
It gives you a chance to read the actual policy contract, make sure you understand all the terms, definitions, benefits, and exclusions, and if you decide it's not right for you for any reason, you can return it within that period for a full refund of any premium paid. If you accept it, you sign any required delivery receipts and make your first premium payment to put the coverage into effect. It's a thorough process, but knowing the steps helps manage expectations.
That gives a clear roadmap. Now, let's circle back to something you mentioned earlier, riders. These are the optional add-ons, but our sources make it clear that some are highly recommended for making the policy truly effective, not just a basic shell. Which ones really stand out?
Yes, riders add significant value, tailoring the policy beyond the basic framework, and they are often well worth the additional premium. The material highlights a few key ones that come up again and again. The partial disability benefit rider, sometimes called a residual disability rider, is often considered one of the most crucial.
Okay, tell us more about that one. Why is it so important?
Well, without this rider, many base policies only pay benefits if you are totally disabled, meaning you cannot do any work at all, or cannot perform any duties of your specific job, depending on that core definition.
But disability isn't always all or nothing, right?
Exactly. That's the key. Disability isn't always black and white. What if you can still work, but only part-time due to fatigue or treatment schedules?
Yeah.
Or maybe you could do most of your job duties, but a few essential ones are now impossible because of your condition, causing a significant income drop.
Like our surgeon who can't operate but maybe could do some consulting or teaching part-time.
Precisely. A partial or residual disability benefit rider allows you to receive a portion of your monthly benefit, even if you are only partially disabled, provided you're experiencing a documented loss of income due to the disability. Typically, this kicks in if your income drops by, say, 20% or more for a basic rider, or maybe 15% or more for an enhanced version.
So it helps bridge that gap when you're still earning something, but not your full potential.
Exactly. It helps bridge that income gap during recovery, during a phased return to work, or if your condition stabilizes at a level where you can work somewhat, but not fully. The sources note that almost all clients they surveyed included some form of this rider, which really underscores its perceived value.
It seems like a critical feature for covering the messy, gray areas of disability and recovery. What's another important rider that comes up?
The cost of living adjustment, or COA, rider. This one is all about protecting your benefits' purchasing power over the long term.
How does it do that?
Think about it. If you become disabled in your 40s and receive benefits for, say, 20 years until retirement, a fixed monthly benefit of $5,000 today will buy significantly less 10 or 20 years from now due to inflation.
Right. The cost of everything goes up.
Exactly. A COLA rider annually adjusts your monthly benefit, typically after you've been disabled for a certain period, like 12 months, by a predetermined percentage or formula to help your benefit keep pace with the rising cost of living.
So your $5,000 monthly benefit might become $5,150 next year, then adjusted again the year after, and so on.
Precisely. The sources mention different versions, like a flat 3% compound increase each year, or maybe an increase tied to the Consumer Price Index, CPI, potentially capped at something like 6% per year. Some policies offer a delayed COLA that starts increasing later, maybe after 4 years of disability, which can be a less expensive option. Given that long-term disabilities can last decades, this is crucial. About 75% of policies surveyed included a COLA rider, which shows how important it is considered for long-term claims.
Makes sense. Protects against inflation eroding your benefit. And the third prominent rider mentioned is the Future Increase Option, or FIO rider. What's the purpose of this one?
This is particularly valuable for younger professionals or business owners whose income is expected to grow significantly throughout their careers. When you first buy a policy, you buy an amount based on your current income. But what happens when your income doubles in 10 years? Your initial benefit amount might become inadequate.
So this lets you increase it later.
Yes, but crucially, it allows you to purchase additional coverage later on, often at set intervals like annually, up to a certain age like 55. without having to undergo a new medical exam or prove you are still insurable based on your health at that time.
Oh, that's the key part, without proving insurability again.
Right. You only need to provide financial documentation showing that your income has actually increased enough to justify the higher benefit amount. So if you buy a policy in your 30s with an FIO, and then maybe develop a chronic health condition in your 40s, that might make you uninsurable otherwise.
You can still increase your coverage as your salary grows in your 50s because you locked in that right when you were healthy.
Exactly. The sources give an example. You might buy a policy today with a $5,000 monthly benefit and add a $5,000 FIO option. This guarantees your right to increase your total benefit up to $10,000 a month in the future in increments, regardless of any health issues that arise, provided your income supports the increase. This was the third most popular rider among those surveyed in one source.
Wow. So those three, partial residual, COA, and FIO, seem like really powerful tools to customize and enhance the basic policy.
They really are. While they add cost, they allow you to build a much more robust and responsive safety net tailored to your individual situation and future potential.
Riders clearly enhance the value. But now let's move to a topic that was highlighted as having an absolutely critical, potentially massive financial impact, and that's taxation. The sources make it very, very clear that how your premiums are paid determines whether your future benefits are taxed, and this can lead to huge differences in your net payout.
This is where understanding the details is paramount because it affects the actual amount of money hitting your bank account when you might need it most. The fundamental principle, as you said, sounds straightforward on the surface.
What's the basic rule?
If you pay the insurance premium using pre-tax dollars, meaning you didn't pay income tax on the money used for the premium, then the benefit you receive later is considered taxable income. Conversely, if you pay the premium using post-tax dollars, meaning you already paid income tax on that money, then the benefit is received entirely tax-free.
Pre-tax premium equals taxable benefit. Post-tax premium equals tax-free benefit. Seems simple enough.
It seems simple, but the complexities arise especially with employer-sponsored plans and how they're structured, plus something the IRS uses called the 3-year look-back rule.
Okay, what's the 3-year look-back rule?
Yes, this IRS rule comes into play particularly with contributory policies where both employer and employee pay, or situations where an employer changes the way premiums are handled over time. If the method of premium payment has changed in the past 3 policy years leading up to your disability.
The 3 years right before you get disabled.
Exactly. The taxability of your benefits isn't just based on the current year's payment method. It's determined by the proportion of premium paid by the employer using pre-tax funds versus the portion paid by the employee using post-tax funds averaged over those past 3 years.
Wow, okay, that adds a layer of complexity.
It does. And significantly, the sources note that changing insurance carriers actually resets this 3-year clock. It can get complicated, which is why understanding the underlying structure of how premiums are paid from the start is so key.
So let's walk through the different ways premiums can be paid, as detailed in Source 5, and what that means for taxes. Starting with the simplest, perhaps, non-contributory.
Okay. In a non-contributory setup, the employer pays 100% of the premium for the employee. And crucially, they pay it using pre-tax dollars. The employee doesn't see the premium cost reflected as taxable income on their paycheck, which feels like a nice perk up front.
Seems like free insurance.
It feels like it. However, the consequence is that any benefits received down the road if you become disabled are fully taxable income to you, the employee. The employer gets a tax deduction for the premium payments, but your net benefit is significantly reduced by taxes just when you need the full amount.
Okay, so free upfront means taxed later. What's the alternative if the employer pays?
That brings us to what's called a gross-up structure. Source 5 refers to this as often being the gold standard from the employee's perspective.
What is that?
With the gross-up policy, the employer also pays 100% of the premium cost. But here's the difference. They include an amount equal to the premium value in the employee's taxable gross pay each pay period.
So the employee pays income tax on the value of the premium.
Correct. The employee pays income tax on that grossed up amount, even though the employer covered the actual premium cost. Because the employee has effectively paid tax on the premium value, any benefits received later are entirely tax-free. This is much preferred by employees because they receive 100% of the promised benefit amount without it being reduced by taxes during disability.
So the employer covers the cost, but ensures the employee pays the tax on it, making the benefit tax-free. Clever.
It is. Then there's a relatively newer option enabled by an IRS ruling called tax choice.
Tax choice, how does that work?
This structure also involves the employer paying 100% of the premium, but it gives the employee agency. The employee gets to choose, usually on an annual basis or maybe as a one-time irrevocable election, whether the value of that employer-paid premium is included in their taxable income, making it post-tax, or not, leaving it pre-tax.
So the employee decides if they want taxable or tax-free benefits later.
Essentially, yes. The choice the employee made for the tax year in which the disability occurs is what determines the taxability of all subsequent disability benefits paid out for that claim. If they chose post-tax treatment for that year's premium, meaning they paid tax on the value, the benefits are tax-free. If they chose pre-tax treatment, no tax paid on the value, the benefits are fully taxable. It puts the decision and the ultimate tax consequence directly in the employee's hands.
Interesting. What about contributory policies where the cost is shared between employer and employee?
Right. In a contributory structure, the employer pays a portion of the premium and the employee pays the rest, often through payroll deduction. Typically, the employer's portion is paid pre-tax and the employee's portion is paid post-tax.
So mixed payments. How are the benefits taxed then?
This is where that 3-year look-back rule really kicks in. The benefits are taxed proportionally based on who paid what percentage on average over the last 3 policy years. If, over those 3 years, the employer paid 70% of the total premium pre-tax and the employee paid 30% post-tax, then 70% of any benefit received would be taxable income and 30% would be received tax-free. It can be quite complex to track and predict the exact tax liability.
Yeah, that sounds potentially confusing. Then there's a common setup called core buy-up plans.
Yes, you see this often in larger companies. The employer might pay for a base core policy, providing a lower level of benefit, maybe 40% or 50% income replacement. The tax treatment of this core benefit depends entirely on how the employer structured that part. It could be non-contributory taxable benefit, gross-up tax-free benefit, or tax choice. Depends on employee election.
And the buy-up part.
The employee then has the option to buy up additional coverage on top of the core, maybe another 10% or 20%, to reach a higher total replacement percentage, like 60% or 70%. If the employee pays for this buy-up portion with their own post-tax dollars via payroll deduction,
then the benefit from that buy-up portion is tax-free.
Exactly. This structure allows employers to provide a basic safety net while letting employees secure a higher overall benefit, with at least the buy-up portion being tax-free.
What about purely voluntary policies offered through work?
In a standard voluntary plan, the employee pays 100% of the premium, usually via payroll deduction. The key here is how that deduction is taken. If the employee ensures these deductions are taken out of their paycheck after taxes have been calculated, i.e. post-tax,
then the benefits are tax-free.
Correct. The benefits are received tax-free. This is often an option when employers can't afford to contribute to premiums, but still want to facilitate access to group coverage rates for their employees.
Okay, and finally, the structure that Source 5 warns strongly against. Voluntary under Section 125 POP. What's the danger here?
This is the crucial one to be wary of, if not actively avoid if possible. Here, the employee pays 100% of the premium, but they elect to do so using pre-tax dollars through what's called a Section 125 cafeteria plan or a premium-only plan, POP.
Why would someone do that?
The immediate appeal is a small reduction in their current taxable income because the premium amount isn't subject to income tax that pay period. It saves a few dollars up front.
But what's the catch? It sounds like there's a big one.
There is. The devastating trade-off is that because the premium was paid pre-tax, any and all benefits received, if you become disabled under that policy, are fully taxable income. The sources emphatically state that the small upfront tax saving on the premium is minuscule, absolutely dwarfed by the massive tax burden on the benefit payments when you need every single dollar to replace your lost income during a disability. It's generally considered a very poor trade-off.
Okay, let's make this impact crystal clear with the examples from Source 5. They are incredibly powerful in showing the dollar difference. Take the first example. An employee earning $45,000 per year with a policy providing a 60% income replacement. That's a $2,250 monthly gross benefit.
Okay, so $2,250 a month. Now, if that employee's premium was paid pre-tax, like in the Section 125 scenario or a non-contributory plan, and they become disabled and fall into, say, a 20% combined federal and state income tax bracket.
20% tax on $2,250.
That's $450 per month going straight to taxes. It leaves them with a net take-home benefit of only $1,800 per month.
Okay, $1,800 net. But what if that same $45,000 earner had ensured their premium was paid post-tax? like via gross up, or a standard voluntary post-tax deduction.
Then $0 of that $2,250 benefit go to income taxes. They receive the full $2,250 net benefit per month.
So the difference is $450 every single month.
Exactly. That's $5,400 over a single year. Now, stretch that over a fairly common 5-year disability claim. That's a difference of $27,000 more in tax-free benefits received.
Wow.
Purely because of how the premium was handled. $27,000 difference for someone earning $45K. That's significant money.
That really is significant. But the higher earner example from the source is even more striking. Let's take someone earning $150,000 per year, same 60% benefit policy. That means a $7,500 per month gross benefit.
Okay, $7,500 a month. If their premiums were paid pre-tax, and let's say they're in a higher 30% combined tax bracket when disabled,
30% of $7,500 is?
that's $2,250 going to taxes every month. Their net monthly benefit is only $5,250.
$5,250 net. Now, what if that same 150K earner had paid their premiums post-tax?
Zero tax on the benefit. They get the full $7,500 net benefit per month.
So the difference there is $2,250 per month.
Per month? Annually, that's a difference of $27,000.
$27,000 a year difference.
And over that same 5-year disability period, that totals a staggering $135,000 in additional tax-free income received.
Wow. $135,000 more over 5 years on a 150K income. Just from understanding and correctly structuring the premium payment, that is an absolutely game-changing difference. That brings the taxation section from feeling potentially, a bit dry to being one of the most impactful parts of this whole conversation.
It really does. It highlights how the tax structure fundamentally impacts your actual take-home replacement ratio. Source 5 makes this point clearly. For that $150K earner, a 60% gross benefit only replaces about 60% of their pre-disability take-home pay if the benefit is taxable.
Right.
But if that same 60% gross benefit is received tax-free, it actually replaces closer to 85.7% of their previous take-home pay.
Because their original salary was taxed, but the benefit isn't.
Exactly. You can achieve a much higher net replacement ratio with tax-free benefits, even with a lower gross benefit percentage on the policy. This allows policies to target, for example, a 60% gross benefit that results in a roughly 75–85% net replacement ratio, which is often considered sufficient to maintain living standards while still providing some incentive to eventually return to work, as the source notes.
So the crucial takeaway here is massive. Ensuring your disability benefits are received tax-free, even if it means paying a little bit of tax on the premium value now through gross-up or post-tax deductions, can be worth tens or even hundreds of thousands of dollars if you ever have a long-term claim. It's a critical financial planning detail that absolutely cannot be overlooked.
Absolutely. It's arguably one of the most important financial leverage points within the policy structure itself.
Okay, so you've done your homework, you've secured the right policy, maybe added valuable riders like own occupation and co-LA, and you've hopefully structured it for tax-free benefits. You feel prepared. But sometimes, even with coverage in place, the process isn't smooth sailing. Our sources touch on a difficult reality. Claims can, and sometimes do, get denied.
Unfortunately, yes. While the insurance is designed to be there, the process of actually getting the benefits when you need them can sometimes be challenging. The sources acknowledge that insurance companies do frequently deny claims, even ones that seem valid initially.
Yeah, there was that quote mentioned.
Yeah, they even quote Stephen King saying, "The fun stops once a claim is lodged," which, while maybe darkly humorous, reflects the common experience that the claims process can feel like a battle sometimes.
So the material provides a list of 10 common reasons why long-term disability claims get denied. Let's go through them, and importantly, touch on what counter strategies are suggested to fight back if this happens to you. First up, insufficient medical evidence.
This is perhaps the most common reason cited. The insurer essentially claims the medical documentation you've provided. Doctor's notes, test results, treatment history isn't strong enough or detailed enough to prove your condition meets the policy's definition of disability or doesn't support the level of limitation you're claiming.
So what do you do?
The counter strategy is to work very closely with your treating physician or physicians. Ensure they provide detailed medical records, comprehensive narrative reports, and clear statements that outline your diagnosis, your prognosis, your ongoing treatment plan, and crucially, specific functional limitations, what you can and cannot do that prevent you from working. Your doctor's detailed documentation is absolutely paramount.
Okay. Reason number 2 for denial, failure to meet the policy's definition of disability.
This goes right back to our earlier discussion about own occupation versus any occupation. The insurer might concede you have a medical condition, but argue that it doesn't prevent you from working according to the specific definition written in your policy.
So they agree you're sick, but say you can still work based on the contract language.
Exactly. The strategy here is to thoroughly understand your policy's specific definition. Is it ONOC, NEOC, something else? And provide evidence that directly speaks to meeting that definition. If you have an own occupation policy, focus documentation on how your condition prevents the substantial and material duties of your specific job. Sometimes, the sources suggest, involving a vocational expert who can analyze your job duties and compare them objectively to your documented limitations can be helpful evidence.
Third reason, pre-existing condition exclusions.
Yes. If the insurer believes your disabling condition stems from or is substantially related to a pre-existing condition, one that was diagnosed or treated before your coverage began, they might deny the claim based on the policy's exclusion clause for pre-existing conditions.
How do you fight that?
You need to carefully review the exact wording and the time limits, look-back period, waiting period, of the pre-existing condition clause in your specific policy contract. There might be arguments to be made that your current condition is distinct, or that it significantly worsened after the exclusion period ended, or that the current disability is from a completely new, unrelated issue. It requires careful reading of the policy language.
Number 4, lack of objective evidence, especially for subjective conditions. This sounds tricky.
It is. This is a major hurdle for conditions like chronic pain, chronic fatigue syndrome, fibromyalgia, or many mental health conditions where standard objective diagnostic tests like X-rays, MRIs, or blood tests may not show a clear physical abnormality that directly correlates with the level of reported symptoms.
But the conditions are still real and disabling.
Absolutely. But insurers often push back, demanding objective proof. The strategy here is to provide as much corroborating evidence as possible, even if it's not a single definitive lab result. This includes detailed reports from treating specialists, results from functional capacity evaluations, FCEs, which are standardized tests designed to objectively measure your physical abilities and limitations, and maintaining detailed daily activity logs yourself, describing your symptoms, limitations, and how they impact your ability to function on a day-to-day basis. Consistency and detail matter.
Reason 5. Incomplete or incorrect paperwork.
Paperwork. This one sounds simple, but simple errors or omissions on the initial claim application or subsequent forms can lead to processing delays or even outright denials. The counter here is vigilance. Double-check everything. Be meticulous when filling out forms. Given the complexity and the high stakes, the sources suggest that considering help from an experienced disability insurance attorney or advocate early on, just to ensure your claim submission is complete, accurate, and presented effectively, can be invaluable.
Okay. Now, this next one is something many people might not even think about until it happens. Insurance company surveillance. Surveillance, you mean like hiring a private eye?
Sometimes, yes, although less common now. More frequently today, it involves monitoring your online activity. Facebook, Instagram, Twitter, even TikTok, as one source mentioned.
What are they looking for?
They are looking for any evidence, photos, videos, or posts that seem to contradict your claimed physical or mental limitations. If you're claiming severe back pain prevents you from sitting for more than 10 minutes, but you post pictures from a long road trip.
That could be used against you.
Definitely. The counter strategy is twofold. First, be genuinely mindful and cautious about your activities, and especially anything you post publicly or online while your claim is pending or being paid. Assume you could be monitored. Second, if surveillance evidence is used against you, you must counter it with clear medical evidence from your doctor, explaining any apparent discrepancies, clarifying the context, or demonstrating how infrequent good days don't negate the overall disability. Don't let a snapshot define your condition.
That's unsettling, but a really important heads up. Reason 7 for denial. Disputes over medical opinions.
This happens a lot. Insurance companies often have their own in-house medical reviewers. Or they might hire outside doctors to review your file. Or they might send you for what's called an independent medical exam, IME, with a doctor they choose and pay.
And surprise, surprise, that doctor might disagree with your doctor.
Frequently, yes. These insurer-hired doctors may conclude your condition isn't as severe as claimed, or that you have the capacity to work, contradicting your own treating physician's opinion. The insurer might then rely solely on their doctor's opinion to deny or terminate the claim.
What's the recourse there?
You need to challenge the insurer's medical findings directly. Highlight any inconsistencies, lack of specialization, potential bias, or briefness of the examination in the IME report. Provide strong, detailed counter-opinions from your treating doctors who have the long-term picture. You might even need to request or obtain your own independent medical review to counter theirs.
Okay. Number 8, gaps in medical treatment.
If there are periods where you weren't consistently seeing doctors or following the recommended treatment plans for your condition, the insurer might argue that you're not doing everything reasonably possible to improve, or perhaps that your condition can't be that severe if you're not seeking regular medical care.
So you need to keep up with appointments.
Ideally, yes. The counter is to adhere to your doctor's prescribed treatment plan as much as possible. If there were legitimate reasons for gaps in treatment, maybe financial issues, difficulty getting appointments with specialists, side effects causing you to stop a medication, lack of transportation, you need to document and clearly explain those reasons to the insurer. Don't let them assume the worst.
Reason 9 is closely related. Denials. After an independent medical exam, IME.
Yes, this is a specific instance of the medical dispute issue. When the insurer sends you for that IME with a doctor of their choosing, the resulting report often tends to minimize your limitations or suggest you have more capacity to work than you feel you do. This unfavorable IME report then becomes the primary basis for a claim denial or termination.
So what do you do when facing an IME?
Your strategy is, first, be prepared for the IME. Be honest and cooperative, but thoroughly and accurately describe all your symptoms and limitations during the exam. Don't exaggerate, but don't downplay things either. Crucially, afterward, obtain a copy of the IME report and have your treating physician review it carefully and provide a detailed written rebuttal, highlighting any inaccuracies, omissions, or points of disagreement based on their long-term clinical knowledge of your specific condition.
Get your doctor to fight their doctor's report.
Essentially, yes. And the 10th common reason listed, the insurer claims improvement in your condition.
This is for when you're already receiving benefits.
Exactly. This often happens during periodic reviews of ongoing claims. The insurer might review your file, maybe conduct surveillance, or get an updated medical opinion and conclude that you've recovered enough to return to work, leading them to terminate your benefits.
How do you counter that if you're still disabled?
You need to continuously provide updated medical records from your treating physicians that clearly document your current functional limitations and ongoing symptoms. If the insurer is relying on outdated information, or perhaps cherry-picking brief periods of improvement, your ongoing documentation needs to demonstrate clearly that your condition still prevents you from meeting the demands of work according to your policy's definition of disability. Consistency in medical evidence is key.
Wow, that's quite a list of potential hurdles.
It is. And as the sources clearly note, navigating these denial reasons and fighting back effectively is complex, it's time-consuming, and frankly, it can be incredibly overwhelming, especially when you're already dealing with the stress of a disabling health condition and loss of income.
So what's the bottom line advice if your claim gets denied?
The good news, reiterated in the material, is that you absolutely do not have to go through this alone. There are experienced attorneys who specialize specifically in ERISA law, which governs most employer-sponsored plans, and private disability insurance claims and appeals. Seeking legal help from someone who understands this specific area of law is often a necessary and highly recommended step when your valid claim is contested or denied. They know the tactics insurers use and how to build the strongest possible case for your benefits.
That covers a huge amount of ground. Really, from understanding the initial risk all the way through to navigating potential challenges with actually getting paid on a claim, it's crystal clear that this isn't a simple topic you can just gloss over or assume is handled.
It truly isn't. And hopefully, this deep dive into the source material we had has pulled out the most critical pieces of information you need. To quickly summarize the key takeaways.
Okay, let's recap. First, long-term disability insurance is vital income protection, not some fringe luxury product. Especially given that statistic 1 in 4 workers will experience a disability during their career, and the very real link shown between disability and potential financial devastation.
Second, understanding the key components of your policy is absolutely paramount. Pay close attention to the waiting period, elimination period, so you know how long you need savings to last. And scrutinize the definition of disability, ideally aiming for own occupation coverage for the strongest protection of your specific career and income level.
Third, don't forget about riders. Optional riders can add significant practical value. Seriously consider a partial or residual disability benefit rider for situations where you're not totally disabled but have income loss. Think about a Hugh Poe rider to protect your benefits purchasing power against inflation over potentially many years. And if your income is likely to grow significantly, look into an FIO rider to lock in the ability to increase coverage later without new medical underwriting.
Fourth, and this one is potentially the most financially impactful point we discussed. Understand how your premiums are paid because it dictates taxation. Ensuring your benefits will be received tax-free, typically by paying premiums with post-tax dollars, can result in you receiving tens or even hundreds of thousands of dollars more in net benefits over the life of a long-term claim compared to receiving taxable benefits. Actively avoid paying disability premiums pre-tax via Section 125 POP plans, if at all possible.
Huge point. And finally, be prepared for the possibility that a claim might be denied, even if you believe it's valid. Understand the common reasons why this happens, like lack of evidence or disputes over the definition, and know the strategies you can use to build a strong case and fight back. That includes being cautious about information you share publicly, particularly online via social media, and knowing that professional legal help is available and often necessary if you face a denial.
Yeah, this isn't something to put off or assume won't happen to you based on wishful thinking. The data suggests otherwise. It really should be considered a foundational piece of personal financial security, arguably just as important as having health insurance or saving for retirement, especially if you have family members who depend on your income.
So the call to action here is clear. Take action based on what you've learned in this deep dive. If you have disability coverage through your employer, pull out the details. Find out the benefit amount, the waiting period, the definition of disability, own osili, enioki, and crucially, figure out how those premiums are being paid pre-tax or post-tax.
If you have an individual policy, review those same details. If you don't have coverage, or if you're self-employed and need that personal income protection or maybe business overhead protection, start exploring getting an individual policy.
Who should you talk to?
Talk to a trusted, independent financial advisor or an insurance broker who genuinely specializes in disability insurance. They can help you assess your needs, compare policies from different carriers, explain the nuances, and navigate the application process. Make sure you understand those policy definitions, waiting periods, and critically confirm how those premiums are handled so you can aim for tax-free benefits if you ever need to make a claim. It requires a bit of time and effort up front, there's no doubt about it, but the potential downside of not having this protection in place, given the statistics and the potential impact, is just catastrophic for most people.
Which leaves us with the final question, the one to really mull over after digging into all this material. Considering that 1 in 4 statistic, the potential for complete financial ruin if disability strikes, and the significant game-changing difference that understanding critical details like taxation can make in the actual money you'd receive.
The real question isn't really whether you can afford long-term disability insurance,
but whether you can possibly afford not to have it, especially when you consider the devastating impact losing your income could have on your life and your family's future.
Thanks for joining us for this deep dive into protecting your income. We hope this information empowers you to make informed decisions about securing your financial future.
Stay informed and stay protected.